Hello, welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 25 minutes, we'll try and get answers to three key questions, which some of you have been writing to me for the last couple of weeks. Apologies for not being able to take those questions in the earlier shows. But this week, we've tried to only focus on three specific, very disparate questions to which we'll try and get answers from both our experts today, Saloni Sanghvi, founder of My Wealth Guide, and Kirtan Shah, co-founder and CEO of SRE Wealth. Both of you, thank you so much for joining, and I hope all is safe with both of you.
Thank you for having us.
So, sorry to make both of you speak together. But okay, let's start with the first question. And I think I've got this question from so many people right now over the last 2 or 3 weeks that if they want to stay invested in equities, but want some bit of defensive element to their portfolio, what is it that they can do? Of course, via the mutual fund route. Saloni, can I start with you? What should an average investor do if she or he wants to stay invested in equities through the mutual fund route, but wants to be a bit defensive?
Sure. So, Neeraj, actually, if we were to, look at defensives, essentially, which is one category of stock, these are basically businesses that deal with necessities and essentials like healthcare, consumer staples, utilities, etc. And because there's a constant demand for their products, they tend to be more stable during various phases of the business cycle and the market cycle as well. For example, in the global financial crisis, when the index fell by 55%, FMCG stocks fell only by 3% and healthcare by 17%. Also, technology, which is not traditionally considered to be a defensive sector, but it has been behaving a lot like defensive stocks, especially during the current downturn. I personally feel, it's a good time to buy defensives when one has a bearish outlook on the economy because they obviously perform better during recessions. Now, while there may be a correction in the markets, I think over a long-term perspective, economically, we're at a cusp of a long-term growth trajectory. You can see shoots of that in corporate results, GST collections, etc. And most large cap, flexi cap funds already have a good exposure to have a 30% exposure to defensives, including technology, which I think is a good exposure to have. So usually a separate fund is not necessary. But, in case if someone still wants to be a little defensive and wants some exposure to that segment, I would recommend the ICICI Technology Fund. The fund has been around for more than 21 years. It has delivered a CAGR of 32% versus 30% for the benchmark over a 5-year period. And it holds stocks like Infosys, HCL Tech, Tech Mahindra, TCS, etc. And on the pharma front, I think one can look at the Nippon Pharma Fund. The fund was launched in 2004, and it has delivered a return of around 17% versus 11% for the benchmark, again over a 5-year period. So this fund also holds stocks like Sun Pharma, Dr. Reddy's, Divi's. So these are some segments that can give some comfort in case if there were a market correction. But I feel over a longer term perspective at this point, defensive is maybe not necessarily the right way to go.
Okay, thanks for that, Saloni. Viewers, remember the premise of this question is not to ask our experts whether or not they believe there will be a correction and therefore they'll take an exposure to defensives or no. The premise of this question is if you believe that you as an investor want some defensive element in your portfolio, then what you can do if you are strictly a mutual fund investor. Please do not make an assumption that our experts are saying that there is a correction around the corner and therefore you should have some defensive element. Maybe there could be, but that's not the premise of this conversation. Kirtan, same question to you. Somebody wants to stay invested largely in equities, wants a defensive bet. Let's assume that's the desire of the investor. What should she or he do?
So, Neeraj, I largely concur with what Saloni did mention. My slight apprehension while we talk about retail investors is that a lot of us don't get thematic investments correct. I would say most of us don't understand because largely, in my opinion, though the thematic funds are actively managed, there is a layer of active management required at the retail investors end as well, because these are very cyclical. And for me, I'm not sure how many of our investors watching the show will really be able to do that on their own. So if you really ask me if the defensive theme has to be played with respect to the current market situation, I think I'll split that into two. First is, in my opinion, look, what I'm going to advise to you is very tactical in nature. But in my opinion, if there is somebody who comes with a 5-year, 7-year kind of horizon, they can still stick to the traditional diversified funds that they've been doing. But let's say they have additional money and they want to, kind of park it currently till the time they get better opportunities in the market to invest. I think hybrid is a good category to look at this point in time from that perspective. Now, I'm sure viewers know, but the typical advantage that hybrid, in my opinion, brings on board is the diversification that it brings with the fund being allowed to invest across equity, fixed income, preference shares, gold, REITs, InvITs. Of course, that depends on what category of hybrid are you really looking at. But in my opinion, if I can split this into three, let's say there are three categories of investor. The first one who's conservative. So if there is somebody who's conservative, wants to take a technical bet because she feels that the market is slightly expensive today, can look at something called as a conservative equity savings fund. So the conservative guy can look at equity savings fund. These typically are funds which would do 10 to 50% kind of equity exposure. Now, though theoretically it might have as high as 50% exposure, but realistically the equity exposure is much lower. But if there is somebody who's kind of moderate in terms of risk profile, can definitely look at something called as balance advantage funds or dynamic asset allocation funds. Again, these funds are funds which can do anywhere between 0 to 100%. And all of these funds use different models to decide the kind of equity level that they really want to follow. But if there is, so to the very specific question, if there is an aggressive investor, right, who's been in equity all throughout, but wants to take a slightly more defensive bet, I think aggressive hybrid fund category makes a lot of sense currently, in my opinion. So these are funds which have 65 to 80% equity exposure and the remaining in debt. But if you look at the last couple of years, very specific performance of these funds versus Nifty. So the first thing, of course, we understand that with 65 to 80%, they are not apple to Nifty. But in 9 out of 10 occasions, aggressive hybrid funds on an average category has been able to beat Nifty even with a lower risk, because it would typically have a 35 to 20% kind of debt exposure. So I think depending on the risk profile that you bring on board, and if this is more tactical because you are concerned of the market valuations, I think hybrid can be one thing that can be considered.
Okay. Viewers, keep in mind, if you want to understand more about hybrid funds, as you know, the first show of every month, Axis Mutual Fund and Bloomberg Wind have tied up to get you a complete learning perspective on what are the different kind of hybrid funds and what would each of them do. So you can try and log into that and learn about them. Kirtan, may I just request you, would you have some specific examples within each of these categories? It need not be the only example that you have, but maybe a couple of names would help.
Absolutely. So let's say if I have to name a couple of funds, I think while it is equity savings, I would look at a Kotak equity savings, probably a BAF category. I think DSP, dynamic asset allocation fund, makes a lot of sense to us. And while we look at the aggressive category, we are more inclined towards mid-asset hybrid equity. So these are the three funds that we probably can look at in each of these categories, Neeraj.
Very cool. Okay, so that's viewers, as far as you wanting a defensive bent to your portfolio. These are some of the options that you can consider. If you have a financial advisor, please do consult the financial advisor as well. Otherwise, what our experts have suggested seems to be pretty foolproof, so to say. Let's move on to the next question that a few people had, and which is that is there some change to the debt portion of the portfolio that you can make or should make with the hypothesis that the Reserve Bank of India may make some changes to interest rates, and should you position your portfolio for the same? Saloni, what's your thought? I mean, do you believe that that's going to happen? And if so, how would you alter what would you advise for people to do the alterations on the debt side of the portfolio?
Right. So I think the RBI imperative right now is one, to let growth and recovery gain further traction. And second is also manage inflation. Now, inflation has come off, a bit to 4.35%, which is well within the comfort zone. In the recent meet, while RBI kept rates unchanged, they indicated that they would take measures to reduce the liquidity in the system. So it is possible that we may see a gradual increase in interest rates over the next 2 to 4 quarters. But that being said, I don't see an extremely large sudden hike. Even if there's an increase, it would be gradual in nature. So for those who invested based on their time horizon, I would recommend them to stay put instead of trying to churn the portfolio and incurring short-term capital gains, because the benefit of debt fund is essentially also your long-term capital gain. For new investments, it would be better to look at the shorter end of the duration and gain advantage of rising interest rates. So I think one category that we can look at in this segment is floater funds. Floating rate funds offer a floating rate which would be the beneficiary of any interest rate hike. Since currently, obviously, there are limited floating rate instruments available, funds basically entered into a swap to convert the fixed rate papers into floating rates. So I think that could be a good way to play, an increase in interest rates going forward.
Okay, Saloni, so effectively you are saying that you are opting for the floating rate funds simply because there is a possibility that there could be an upward trajectory of rates, and therefore having a floating rate as opposed to a fixed rate, in the parlance of what home loans are, is advantageous for an investor. And therefore, what kind of floating rate funds, or is there a particular house or a couple of funds that you recommend investors should look at?
Right. That's exactly what I mean, Neeraj, because obviously if interest rates go up, you want the benefit of that. So I recommend the ICICI floating interest fund, which has again been around for 15 years. It has a modified duration of 1.5 and a yield of around 5.2%. Also, if you look at the the credit worthiness of the papers that it invests in, about 75% are in sovereign bonds and AAA rated corporate bonds. So I think this is actually a good way to invest in floating rate funds.
Okay, thanks for that, Saloni. Kirtan, what about your thoughts on both the root cause, if you will, and the options that an investor can exercise?
Neeraj, again, I largely concur with what Saloni did mention, but a couple of things at my end. So if we deep dive slightly more in the RBI policy, I think there were two very specific mentions that RBI came up with. First was doing away of the GSAP and introducing a 14-day variable reverse repo. Now, what both of these things do, right, and without going into too much of technicality, is going to suck out liquidity from the system. So currently there is 9-10 lakh crore worth of liquidity floating around, which probably should come down to 2-3 lakh crore is what I understand reading the document that was published. Now this essentially what this does is that reverse repo rates might not go up immediately, but you would start seeing the 10-year yield and yields at the lower end of the curve start moving up. We've already seen the 10-year move up by 20 pips over the last 2-3 weeks in anticipation of RBI doing this. Right? Of course, how do we get an intimation that RBI is now keen to move up the policy rate? I think that largely comes in when RBI will come and increase the reverse repo rate back to the 50 basis spread. So traditionally, we've seen repo reverse repo in the bandwidth of a 50 basis spread, which is currently 65, right? And that was largely done to infuse liquidity in the system. So though GSAP and the 14-day variable reverse repo definitely gives an indication that they are okay with sucking liquidity out of the system, I think the immediate understanding that rates will start going up will be when RBI will increase reverse repo by 15 bips or 25 bips. Having said that, in my opinion, there is very little that you should do or you can do with respect to your existing portfolio, is because you will end up you will have to look at multiple things like Saloni did mention. But let's say if you have additional investments to do, I think I'll break that into two. Let's say there is somebody who's looking at investing for short term, let's say up to 1 year. I think I'll concur with Saloni that you can opt for something like an HDFC floating rate debt fund. And I think it'll give you the advantage of rising yields at the lower end of the curve for sure. But let's say if you want to invest money today and your investment is upwards of 3 years, right, then floating may not work in your favor. And traditionally, if you've seen in a rising interest rate situation, a strategy called barbell always works well. Barbell in very simple language is you put 50% of your money at the lower end of the curve and you put 50% of your money at the higher end of the curve. So let's say if I've got 100 rupees to invest, today I will invest 50 rupees in, let's say, an Aditya Birla Money Manager, and I'll invest another 50 rupees in, let's say, Aditya Birla Government Security Fund. Now, what this typically ends up doing is, while the interest rates start moving up, typically it's the lower end of the curve that moves up first, given the current situation. Now, when the lower end of the curve keeps moving up, your money market fund that you've invested in will be able to reap the benefit of the higher interest rates. And because rates are extremely low at this point in time, right, the gilt securities that you've invested in will bring in the higher YTM that you really want in your portfolio. If you are able to hold this combination for 3-5 years, I think that can be the best case situation for you to deploy longer term money in debt at this point in time.
Got it. Thanks for that, Kirtan. And Saloni, just one quick follow-up. You mentioned about how people need to take into account the tax element as well, simply because if one is holding some investment for 3 years and if it makes changes earlier than 3 years, then I think the benefits of indexation as well as the tax implications come into play, right?
Yes, that's correct. So basically for debt, long-term capital gains kicks in after 3 years. So after 3 years, you get, there's indexation, and post-indexation, it's taxed at 20%. So that works out to an effective tax rate of 10 to 15%. And that is where the strength of debt mutual funds also lie, in that taxation benefit, especially over a longer term period.
Got it. And viewers, maybe that's why I think both our experts were suggesting that don't make too many changes to your existing investments, because there's only as much you can do, probably nothing. But from a slightly longer term perspective, maybe a few changes here and there. But if you want to understand a bit more, I think a lot of people tweet about their understanding of the RBI's moves, etc. I was forwarded on WhatsApp a tweet thread from Kirtan, which was very informative. So maybe you can try and look up his tweets in order to understand a bit more about this. The last question that we want to be answered on this show from our experts is a very peculiar one. It's not something that happens too often, so I'm kind of narrowing down the number of people who might be interested in this, but still important. And Kirtan, I want to start with you on this. Nippon India filed an EV index fund with SEBI. Now, with the presumption that all of it passes the muster and eventually there is an EV index fund out there in India, should investors take exposure to this? What kind of investor should take exposure to this? Give us your reasons.
Neeraj, look, I am not very comfortable on two parameters. First is, I'm generally not a very gung-ho advisor when it comes to NFOs, right? Because there is hardly any data to fall back on, and while you have multiple other options available, it's slightly disheartening, at least at my end, to go ahead and recommend an NFO. But of course, while we talk about a thematic fund, again, like I did mention in the first question that we were discussing, thematic is extremely cyclical in my nature. And I would repeat what I just said in the last question as well, is that while the fund is going to follow active investment strategy, the investor needs to be active over and above the fund's active management, right? Which in my opinion, unless you are really advised, looking at your requirement and your background, works well, but not in my opinion for general audience. So who should look at it in my opinion? I think that somebody who brings in extremely high risk appetite, has 8-10 plus years of time horizon, because if you look at all of these thematic funds that have been launched over the years since 2008, they've all followed a 7-8 year cycle where they've had 7-8 years of good performance and then a 10-12 years of bad performance. So in my opinion, somebody with 8-10 years of investment horizon, extremely high risk appetite, should or can look at it, but don't get too adventurous with more than 5% of your portfolio in this.
Okay. Saloni, what are your views on this one?
So I think I agree with Kirtan with regards to NFOs. I prefer funds which have a slightly longer track record to evaluate them. But that being said, actually, it's interesting that you picked this topic because lately a lot of people have been coming up to me and asking me about how do you kind of get exposure to electric vehicles. It's a segment that accounts for 26% of global sales. It's going to become 10x in 10 years. So everyone wants to be part of this, this theme essentially. So if you look at the main way of investing in this is essentially index funds or ETFs, which largely are in the US, and about 60 to 70% of the companies in those are also listed in the US. So if you were to look at the composition, this would include companies like Tesla, Alphabet, Nvidia, Microsoft, Apple, Intel, etc. I feel there's a large overlap with NASDAQ 100. So, my recommendation would be instead of investing in an EV specific index, it would make more sense to invest in a NASDAQ 100 because not only do you get exposure to, the electric vehicle theme, but you're also able to play on multiple themes instead of just one specific theme. And again, because the NASDAQ has a lot of companies and a lot of sectors which are actually not present in India and which you can't invest in India, it gives you a good exposure to that.
And how does one invest in such a fund, the NASDAQ 100, Saloni?
So you have multiple options in India to do that. Motilal Oswal has a NASDAQ 100 ETF and a fund of fund which can be used to get exposure to this.
Okay. Viewers, keep in mind, money making can be boring, and which is fine because the end goal matters and maybe not the attractiveness of the process. But money making can be sexy, and if you want it to be sexy, maybe the EV theme might be one way to do it. But please be careful about it. Saloni, Kirtan, thank you so much for joining in today and answering all of these questions. Much appreciate your time, and happy Navratras to both of you.
Thank you so much for having us.
Thank you so much, Neeraj, for having us. It was great to be on the show.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.